Have you ever been interested in how taxes affect your or your client's real estate closing? Well, today we're going to talk about all the different taxes and how they play a huge role in our closings, either before, during, or after. So the first type of tax we're going to talk about is transfer taxes. If you've ever had a deed, you've definitely paid transfer taxes if you paid money for that property. Here in the state of Michigan, our Michigan compiled laws actually tell us how we have to pay transfer taxes. So the first thing we want to note when we're looking at transfer taxes and the way that those work is basically that we have to pay transfer tax based on the value of the property. So it's the total value of the property being transferred. It's not the amount of money that we're writing on a deed, it's the actual value. So if you've ever heard of this fancy phrase called a real estate transfer tax valuation affidavit, which I lovingly refer to as a REPVA, it's this nifty way where we can actually avoid writing the consideration on the deed. So if you have a client who maybe doesn't want everyone to know that you spent $500,000 on this property or $50,000 on the property, instead of writing that consideration on the deed, instead you can file a real estate transfer tax valuation affidavit. And that goes to the Register of Deeds along with your deed. And in order for us to figure out how much transfer tax we have to pay, we don't look at the deed, we now look at our REPVA. So when we're calculating transfer taxes, it's relatively simple until it's not. So there's two main types of transfer taxes that we're going to pay. We're going to pay state transfer tax and county transfer tax. So of course, no surprise that state transfer tax is a little bit more than county transfer tax. And of course, we're not going to make it too easy, okay? We're going to calculate it based on $500 intervals. So you're always going to round your consideration amount up to the closest $500. So if you sell your property for $100,000, that's great. And we don't have to do any rounding. If you sell your property for $100,001, we have to round that up to $100,500 and use that number for our calculation. So that actually works out to about 3/4% if you want to just multiply that rounded number by something simple. You can take $100,500, multiply that by 0.75, and that'll tell you how much state transfer tax you have to pay. And so for county transfer tax, that's a little bit less expensive. That's actually 55 cents per $500, which works out to about 0.11%. So you can do that same thing, take that rounded number, multiply it by 0.11, and that'll get you your transfer tax. So that means in total, we're paying $4.30 per $500 of consideration. So you're going to round up to your 500 and multiply it by 0.86%. And that'll tell you the total amount of transfer tax that you need to pay. So for example, if you've got a sales price of $550,000, your state real estate transfer tax is going to be about $4,000. Your county transfer tax is going to be $605, and that means your total is $4,730. That's kind of a big deal. So we definitely want to pay attention to transfer tax and remember that this is a really important and integral part of our closing. We want to make sure that we're preparing our clients appropriately. And it's also an important thing to remember that most purchase agreements in the state of Michigan also require the seller to pay this fee. So this is something that the seller is usually going to be paying. So the next big section of property taxes, and this one is very near and dear to my heart, is when we're actually talking about genuine property taxes. And we all tend to get a little bit flustered because there's a ton of terms that get thrown around whenever we're talking about property taxes. We hear the terms SEV and TV and capping and uncapping, and oh my, what are we talking about? So the easiest way is let's start with what we know. we know true cash value, right? So we know our property is maybe worth $100,000 or $150,000. And when we're talking about property taxes, we're going to start with a true cash value as well. Now, your taxing unit is going to determine what it thinks your true cash value is. And that's just based on studies over the past few years. They're looking at market sales, things like that. So it's not going to match necessarily exactly how much money you bought the property for. But there will be a determination of what they feel true cash value will be. So in theory, this is basically what the municipality has decided that your property is worth, right? Simple number. We're all comfortable with that one. Now we're going to get a little more complicated. So now we start talking about this crazy SEV that everybody likes to throw around. That stands for the state equalized value. Actually, this is a little bit more simple and much less exciting than we like to make it be. So the state equalized value is really just 50% of true cash value. So we're going to just take that true cash value, we're going to divide it in half. And with that state equalized value, we're also going to find taxable value. But here's the difference. Taxable value will always be the amount that your taxes are based off of. Okay? So your taxable value will be used when we're calculating your actual taxes. Now, taxable value isn't going to change very much. In fact, there's actually some limitations. Each year, your taxable value can only increase a maximum of 5%. And it's going to increase with inflation. So if the inflation is 6%, it's going to be capped at only increasing by 5%. So if your property went up 10% in value, great, congratulations. That's a good year for you. But don't worry, your taxes aren't going to go up 10%. They can't. They're capped at 5%. So when the municipality reassesses and they look and they say, oh, Caitlin, your property value has gone up so much. They're going to raise my true cash value. They're going to raise my state equalized value, and they're going to raise my taxable value, but oh, it's capped. It's capped at 5%, and that's the most it can raise. Now, geez, we know the terms. How in the heck are we going to figure out exactly how much I owe? Well, it's actually relatively simple. We also hear this term mills thrown around. And in very simple terms, 1 mil equals $1 per $1,000 of taxable value that we're going to pay in taxes. So what that means is if your taxable value is $100,000 and your taxes are 30 mils, that means that you owe $3,000 in taxes. Very simple. Okay, you're going to take that millage rate of 30 and multiply it by the number of thousands you have, which is 100. 30 times 100, 3,000. Easy math. Unfortunately, not always that easy, but today, for our example, we like it. So now the real question. We get to the crux of the issue. If I sell my house, how will my property taxes be affected? You know, it's nice to know about property taxes, but I need to know this house I'm looking at, are my taxes about to skyrocket or are they going to stay about the same? And we definitely need to know what's going to happen in the near future. So there's a few different ways that we can do this, right? But the first thing we have to understand is that every year as inflation increases, and our taxable value increases and it's capped at 5%, there's only that cap on the increase while the same person owns the home. So if that property goes and gets sold and someone else buys the home, what's going to happen is something called uncapping. So at the time of the sale, the property is eventually going to be reassessed. That true cash value is still going to exist. That state equalized value is still going to be 50% of that true cash value. But now the taxable value isn't stuck way down here. The taxable value is going to come up to match the state equalized value with that sale. right? So when you sell the property, what's going to happen is you're going to see that taxable value come up to match your state equalized value. And remember that taxable value is what we're using to calculate taxes that are actually owed. So what's a really quick and easy way to look at maybe the seller's tax bill and see, how much are my taxes going to change? You can do a simple quick look at the SEV and the taxable value. Okay, so if you see that SEV is way up here and that taxable value is way down here, you know that when this uncaps on sale, what's going to happen to that taxable value? It's going to come all the way up here so that it matches. So if you're seeing a huge discrepancy between SEV and taxable value, then you know the taxes are going to be very different, aka a lot more, after the closing, okay? So that's a very important thing to look at, an important thing to remember. And also, this is a great friendly reminder. If we see that our SEV has skyrocketed, even on our personal taxes, we don't need to panic, right? Because our taxable value can only increase by 5% so long as that ownership is staying the same. There's also a really cool resource that I put here for you guys. It's a great tax estimator. So it will allow you to estimate what your taxes will be. Now, another fun thing we have to talk about with property taxes is what happens when they're unpaid. So we talk a lot about mortgage foreclosures, which fortunately we're not seeing very many of right now, but there's also this concept of tax foreclosures. So if we don't pay our property taxes, the state, the foreclosing governmental unit, which could be the county, can actually come and foreclose that property because you haven't paid your property taxes in 3 years. So as a reminder, we're always going to make sure that we pay our property taxes, of course, but we pay them to the municipality until they become delinquent. And the state of Michigan tells us that they are delinquent following after March 1st if they're still unpaid. So if your summer taxes and your winter taxes are not paid, the following March 1st, they now become delinquent. Why does this matter? Because now we have to pay them to the county instead of the municipality. But also, there are some really, really, really fun fines that get added. We want to avoid those, right? There's also one other complexity with our closing that we have to think about as well. And a lot of us don't even realize, but every single time we record a warranty deed, we're paying transfer tax, remember, but also we pay a little bonus $5 to the Register of Deeds to do what? They're going to actually tax certify that deed. And what it means is they're actually going to do a little bit of research and make sure that you've paid your property taxes. So what does that mean if you haven't paid your property taxes and they are delinquent, aka after March 1st, you can't record that deed. We have to actually pay those taxes and make them current before that deed can be recorded. So it definitely adds a little bit into our timeline, and we have to be very, very careful. We got to be really careful that we're not trying to squeeze things in too tightly if we have taxes that are categorized as delinquent, meaning not paid until after March 1st. So not necessarily a huge, huge problem for our closing, but definitely something we've got to think about. Now, our favorite thing when it comes to property taxes is the principal residence exemption. And why is it our favorite? Because it means we get to pay less taxes. And of course, Michigan compiled laws, they're going to give us a lot of rules. They're going to tell us when we get to claim this exemption, all right? Because we are given a list of all the things we owe taxes for, and everything is going to have, you're going to have a line item for each thing you owe taxes for and a millage rate to match that, all right? However, in the great state of Michigan, we are allowed this thing called a principal residence exemption, where on our one principal residence, we are allowed to make this exemption where we don't pay up to 18 mills for our school district operating taxes, which is amazing. So on our one property in the state of Michigan, the one we are claiming as our home, right? That's the property we're allowed to claim our principal residence exemption on and get that little tax discount. So that's 18 less mills that we have to pay. Now, there can be some complications with principal residence exemptions. So sometimes if we see that a property has changed hands a ton of times, especially maybe between investors or LLCs or something like that, there's going to be this thing that's called a PRE denial. And that means that maybe someone claimed a principal residence exemption, but they didn't actually qualify for it. And so what's going to happen is after the state does their homework, they're going to say, whoa, buddy, you claimed this exemption and you paid 18 less mills in taxes, but that was not correct. And now you owe us those taxes that you didn't pay because you didn't really deserve that principal residence exemption. Okay, so first of all, we want to make sure that we're doing this correctly because we will still owe those taxes down the road. But second of all, if we're involved in a real estate transaction and the seller claimed that principal residence exemption, but they shouldn't have, we, as the buyer, might actually end up with that tax bill, which is super scary. We don't want to pay for the seller's misdeeds, right? We definitely don't want to pay the taxes that they neglected to pay for however many previous years. So that's where we come in with this thing called a bona fide purchaser. And what we do as the buyer is we say, whoa, we're the buyer. We did not know about the seller's misdeeds. We're a bona fide purchaser. We genuinely are reporting our taxes correctly, and we were not made aware that the seller made this oopsie in the past. And therefore, those past taxes should be passed along to the seller and not stay attached to this property that I now own. Now, there's some really great forms on the Michigan State website that you can actually utilize for these. Also, feel free to give us a call and we can help you with those as well. So, we really can't be done talking about property taxes until we cover property tax prorations. And this is also one of those kind of mystical things that we never really spend a whole ton of time learning, but geez, they are in every single transaction that we handle. Well, they're in almost every single transaction we handle. Now, first and foremost, what the heck is a property tax proration? So in the state of Michigan, most municipalities and counties, we've got two taxes that we pay every year, usually one in the summer and one in the winter. And when the seller pays those, they're either paying them forwards or backwards. But when it's time for a sale, the buyer and the seller are going to come together and determine who needs to recoup the other person for taxes that are going to be paid or have been paid by the other party. So what we're trying to do initially is we've got to figure out our taxing and billing cycles for the municipality that we're in. So for example, if our municipality's billing cycle is what's called advanced, that means that we're paying forward. So if I pay my taxes today, July 1st, I'm paying for my taxes for July 1st, 2024 through June 30th, 2025. I'm paying them in advance. Okay? Now, if my municipality doesn't do it like that, if instead we pay them in what's called arrears, it means when I pay my taxes today, July 1st, 2024, I'm actually paying them backwards. So I'm paying for a tax period from today back through July 1st of 2023. Today's 2024, I'm paying backwards to 2023, okay? So we first have to know, are we paying taxes in advance or are we paying them in arrears, right? Now, the second thing we have to know when we're working with tax prorations is actually the method of proration. So we're gonna figure out how many days during the billing cycle the seller owned the property and the buyer owned the property. But how are we determining that cycle, right? So there's two different cycles we can use. One is the calendar year. Hello, January through December. That's easy. We know that one, right? The second one is due date basis. That's where we're going to use the actual due date of each tax. So for instance, we've got July 1st through June 30th. So our dates that we use will be July 1st and June 30th. Or if we're paying the winter tax, we've got December 1st through November 30th. So we'll use December 1st and November 30th. That's due date. Now remember, calendar year is different. Calendar year is January through December. Due date is the actual due date. So we technically have 4 different ways we can prorate, right? Advanced based on the calendar year, advanced based on the due date, arrears based on the calendar year, and arrears based on the due date. So we've got 4 options. Now, many of us are in the Tri-County area. We're in Wayne, Oakland, Macomb, Washtenaw, Genesee, Lapeer. Those are going to be in advance on a due date basis, okay? So we'll do an example there. If you're on the west side of the state, you're in Lansing, you're gonna do it differently, but the concept works the same, okay? So, for instance, if we have a closing date of February 1st, 2024, now we're going to prorate in advance. So that means whenever the seller paid his taxes in 2023, he paid those taxes forward. He paid them in advance. So when we sell the house on February 1st, the buyer is getting this house with the taxes already paid, right? And they don't have to pay taxes for a little while. So we know because he's paying them in advance, we're actually going to have a credit from the buyer to the seller. Buyer's going to repay the seller because the taxes were paid in advance, right? And remember, if it's in arrears, it's the opposite way. But right now we're going to focus on advance, okay? So everything we talk about for this example is going to be the buyer repaying our seller because it was paid in advance. So now we're also going to do this on the due date basis, okay? So remember, our closing date is February 1st, right? So we're going to prorate based on that February 1st date, and then we're going to run it through to the next billing cycle. So February 1st through June 30th. That time frame is the time frame where the buyer is going to be living in the property, but the seller's already paid the taxes, right? Because the buyer doesn't have to pay another bill until July 1st. So the buyer is going to repay the seller for that February 1st through June 30th. It's going to be very nice for the seller. Going to get a nice little check for that, right? Now we'll do the same exact thing for the winter taxes, okay? So from from February 1st, our closing date, through November 30th, our buyer is again going to pay the seller back for the taxes that they paid while the buyer is actually living in the property. And then of course, come July 1st, come December 1st, the buyer will now have to pay the taxes moving forward. Thanks for hanging out and chatting with me about property taxes today. I appreciate your time. If you're looking for a title company who really knows how to handle property taxes and can answer some questions for you, feel free to reach out at my email address or give me a call. We'd love to work with you. And if you're looking for a little more on taxes, we've got a great capital gains video for you coming up.